In this video tutorial, we learn about duration, what duration is, how to calculate it, its uses and limitations. This tutorial is also unique as you will be able to learn two new smart formulas. Duration of a bond, also known as Macaulay duration, is just like the discounted payback period of a project. However, unlike the discounted payback period of a project, duration is calculated after accounting for all the cash flows of the bond. It is the average length of time taken by a bond to recover its initial investment. That is the price of the bond. Duration of a bond, that is Macaulay duration, is equal to the sum of the time-weighted present values of bond's cash flows divided by the bond price. This term here is representing the present value of the bond's cash flow in period 1, in period 2, and so on. And these are then multiplied by their respective time periods. That is 1 here, 2 here, and n here. So this gives us the time weighted present value cash flow for period 1. This gives us the time weighted present value of cash flow for period 2, and so on. We add these together and divide by the bond price to get the Macaulay duration. Duration is the measure of bond's price volatility with respect to changes in interest rate. Like the beta of equity stock, the higher is the beta, the higher is the risk. The longer is the duration, the higher is the risk, that is the price volatility of the bond. We note the following properties of duration for bonds. Bonds with longer maturities will always have longer durations. Bonds with lower coupon rates will have longer durations, and bonds with lower yields will also have longer durations. Duration, whether Macaulay or modified, of coupon bonds will always be lower than maturity. Macaulay duration of zero coupon bonds will always be equal to maturity. However, modified duration of zero coupon bonds will always be less than maturity. In the first example here, we are calculating Macaulay duration for a 5-year 10% annual coupon bond that has a par value of $1,000 and is selling at $1,000. That is, it is selling at par. So the coupon rate here must be equal to YTM. Following the formula that we have, we first calculate the present value discount factor at YTM, that is the discount rate here of 10%, which is also equal to the coupon rate of 10%. So for the first period, that is year 1, the discount factor is calculated here, which is equal to 0.909. Multiplying this by the first year cash flow, we get the present value of the first year's cash flow. This is $90.91. We multiply $90.91 by the number of year, that is 1 here, to get the time weighted present value of cash flow, which is $90.91 the same. In the second year, the bond is paying again $100 coupon, that is interest, and the present value discount factor is 0.826 at 10%. So multiplying this by the cash flow, we get the present value of year 2's coupon payment, that is 82.64. If we multiply this by the year 2 number, we get the time weighted present value of cash flows, that is $165.29. We do the same till year 5 cash flow, and we get the time weighted cash flows here. We sum all these time weighted cash flows for each year and get 4,169.87. Now Macaulay duration is equal to the sum of the time weighted cash flows in present value terms for the bond divided by the bond's initial investment, that is the price of the bond. In this case, Macaulay duration is 4.17 years. Note, 4.17 years duration is less than the 5-year maturity of the bond. In the second example here, we are calculating Macaulay duration for a bond that is selling at a discount from par value, that is at a price of 927.90, and the YTM is equal to 12%. Now here we have just adjusted the present value discount factor from 10% to 12%, the remaining entries are the same. We see that the present value of cash flows exactly equal the price of the bond here, and the time weighted present values of cash flows are now equal to 3837.31. We do the same calculation and get 4.14 as the Macaulay duration for this bond, which is selling at a discount. In the third example here, we have a bond that is selling at premium to par value, where the YTM is 8%, that is less than the coupon rate of 10%. Using 8% YTM as the discount rate, we calculate the discount factors here for year 1, 2, 3, 4 and 5 and calculate the present values of cash flows. That gives us the price of the bond when we total it. And then we multiply the present values of cash flows in each period by the corresponding year, and this gives us the time weighted present values of cash flows. We sum this and divide it by the price of the bond, which gives us the Macaulay duration equal to 4.2 years. If we want to calculate Macaulay duration in a formula directly and not use a table as in previous examples, here is the formula to do so. To calculate Macaulay duration, we use this formula: 1 plus R divided by R minus 1 plus R plus N into the coupon rate minus the YTM, that is the discount rate, divided by the coupon rate multiplied into 1 plus R raised to the power N minus 1. So we first solve this bit and then multiply it into the coupon rate and then add R, that is the YTM, with it. This formula assumes the par value of the bond to be equal to 1, so we will be using the coupon rate and R in percentages. For example, in the previous case, the coupon rate was 10%. So we will have 0.1 here, and the YTM, that is the discount rate, was 8%. So we will have 0.08 here. If you have to calculate the duration of a bond between two coupon dates, then this term will be added to the formula to account for the days that are remaining till the next coupon is due. Using the inputs from our example 3, we can calculate the Macaulay duration using the formula, and this is exactly equal to 4.2 years. Keep in mind that when you are solving this formula, you follow the order. So first, the difference between 10% and 8% will be calculated, which will be multiplied into 5, and then it will be added to 1.08 here. Similarly here, first you will solve these terms in the brackets, then multiply it to 10% and then add 8%. Now we learn how to calculate the Macaulay duration for a bond that pays semi-annual coupon. So here in example 4, we have a 5-year 10% semi-annual coupon bond that has a par value of $1,000 and is selling at a price of $1,081.11 with a YTM of 8%. We have to divide the 10% coupon by 2 to get 5% as the semi-annual coupon, and that means that there will be a 50 interest payment every 6 months for 10 periods, that is 5 years now. Similarly, we have to divide the YTM of 8% by 2 to get the discount factor at 4% for the 6 months periodic interest payment. We calculate the present values of the semi-annual coupon and final payment here following the same process as we did for annual coupon paying bonds, and then we calculate the time weighted present values of cash flows in each period and we sum them, and then we divide it by the price of the bond to get the duration of the bond. But this duration of the bond is in terms of periods, so it is 8.19 periods. To get it annual, we have to divide this by 2, which is 4.095 years in our case. Modified duration is a very useful tool as it measures the approximate change in the price of a bond in response to a change in interest rate. So for example, if a bond has a modified duration of 3.5 years, a 1% change in interest rate will lead to a 3.5% change in the price of the bond. So if interest rates rise by 1%, the bond price should go down by 3.5% approximately. Similarly, if interest rates fall by 1%, the modified duration of 3.5 implies that the price of the bond should approximately rise by 3.5%. As for stock, the measure of volatility or risk is the beta of the stock. For bonds, the measure of risk, that is price volatility, is modified duration. So the longer is the duration, the higher is the risk. Modified duration can be calculated as dividing the Macaulay duration by 1 plus the discount rate or the market interest rate. And for semi-annual coupon paying bonds, we simply have to adjust the YTM by dividing it by 2. Using the modified duration formula, we can calculate the modified durations for our bonds in example 1, 2, 3, and 4. The first bond had a Macaulay duration of 4.17 and the YTM was equal to the coupon rate of 10%. So using the Macaulay duration and dividing it by 1 plus the YTM, that is R, we get the modified duration equal to 3.79. Then we calculate this 3.7 for the bond in example 2 and 3.89 for the bond in example 3 and also for the bond in example 4 where it pays semi-annual coupon, we get 3.94 as the modified duration. If you want to calculate the modified duration of a bond directly without taking the trouble to first calculate Macaulay duration and then adjust it for modified duration, you can use this formula here to get it. Now, in this formula, the assumption is that the par value of the bond is equal to 100. It doesn't matter because you can easily adjust the coupon here. We have adjusted the coupon from 100 to 10 and the par value from 1000 to 100, and we are using 8% as the YTM as was in example 3. So using our data, and of course we have adjusted the bond price here from 1079 to 107.985. Using these inputs in the formula, we get the modified duration equal to 3.89. We can adjust this to get back Macaulay duration, multiplying modified duration by the term 1 plus the R, that is 8% here, and we get Macaulay duration 4.2, which is the same as we obtained in example 3. Duration is a very useful measure for bonds. As discussed, it is a measure of the risk of fixed income securities and it helps us understand the risk in bonds with respect to changes in interest rates. Now this enables us to compare bonds of different maturities and different coupon rates and determine which one or which are most appropriate given the forecast for interest rates. Duration helps us create and manage bond portfolios. Duration as a measure of risk helps us in managing bond portfolios and take appropriate measures, both tactical and strategic, to take advantage of the expected changes in interest rates or to hedge ourselves against potential risk. The most obvious limitation of duration is that it assumes a linear relationship between bond prices and interest rates. So for a given coupon rate and maturity, the absolute percentage change in price is the same if interest rates go up or if interest rates go down. That is what duration assumes. However, we know that for any given coupon rate and maturity, the absolute percentage change in price is greater when interest rates go down than when interest rates go up. In other words, we say that time value of money increases at increasing rate and decreases at decreasing rate. That is because of the impact of compounding and discounting. Hence, the relationship between bond prices and interest rate is convex and not linear. The convex relationship between bond prices and interest rate is clear from this figure. The estimated prices using duration is shown here on this line, and it shows that the price of the bond changes proportionally for a fall and a rise in interest rates. However, the actual price line shows that the relationship is convex and the price changes more when the interest rate fall than when the interest rates rise. That is the reason that duration is overestimating the fall in the price of the bond for a rise in interest rate and underestimating the rise in the price of the bond for a fall in interest rates. When YTM was equal to 10%, we saw the bond price was equal to $1,000. That is depicted here, where the par value of the bond and the market value is the same when the coupon rate is equal to 10%. Then when the YTM was 8%, we saw the bond price was equal to 1079.85, and that is somewhere, let's suppose, here. So the bond value here at this point is 1079.85. That is the actual price of the bond. Then when YTM was 12%, we saw the price of the bond was equal to $927.9. This is something here. Let's suppose we put this equal to this point. So at this point the price is 927.90. That's the actual prices at 8% and 12%. If we use duration to estimate the price at 8% and the price at 12%, that is if interest rate change by 2%, we know that the duration of this bond here is 3.79. And this implies that for a 1% change in interest rate, the bond price will change by 3.79%. This bond is currently selling at par value because the YTM is equal to the coupon rate of 10%. Now, duration estimates the price of the bond if interest rate increase by 2% to 12% equal to the current price of $1,000 multiplied into 1 minus 2% multiplied into 3.79, that is the duration of the bond, and this gives us the new price of the bond as per duration equal to $924.20. This is somewhere here. So we see that duration here is overestimating the fall in the price of the bond if interest rates rise. If interest rates drop by 2%, duration estimates that the price of the bond will be 1 plus 2% multiplied into 3.79, and multiplying this into 1000 gives us the new price of the bond equal to 1075.80. Hence, this is somewhere here, and this is suggesting that duration is underestimating the rise in the price of the bond if interest rates fall. Note that for interest rate rise, we have a minus sign here, and for interest rate fall, we have a plus sign here. And this is because of the inverse relationship between bond prices and interest rates. So when interest rates rise, bond prices should fall, and when interest rates fall, bond prices should rise. So we see here the current market price, which is equal to the par value of the bond, falls to 924.2 as per duration if interest rates rise by 2%. And we see that the price of the bond rises to 1075.8 if there is a 2% fall in interest rate as per duration. Of course, these are underestimation and overestimation of prices compared to the actual prices. That also has the effect of convexity. This figure shows the error in estimation of the price using duration. So here we see the price error is this much, and if we take our numbers, it is equal to 3.7. That is the actual price of 927.9 9 from the bond valuation formula minus the estimated price using duration as we did on the previous slide. Similarly here, the error is 4.05, which is equal to the actual price of 1079.85 from the bond valuation formula minus the price we estimate using duration, which is 1075.8 from the previous slide. These two errors also confirm another statement that we made previously, and that is that the value increases at increasing rate and the value decreases at decreasing rate. In the next tutorial video, we will cover convexity and its calculation for a bond.